Hello, and welcome to the third quarter review and market outlook from Horizon Investments. My name is Austin Fitch, and I'm joined here today by our Chief Investment Officer, Scott Ladner. Really excited to get into the conversation around our view on markets and the economy and what that means for the remainder of 2024. And as we head into 2025, kind of what we're seeing and how that affects how we're thinking about investment management. It's exciting time in the markets broadly. Obviously, there's a lot of things going on around the world, whether that's elections, whether that's geopolitics. We'll touch, I'm sure, on all of that in some way, shape, or form. But I'm excited to get into the conversation. I will say for folks that haven't been with us in the past, we typically try to dive into some hot button topics. You can see the agenda here on the screen for today. Before we get into that, though, I will say if you have any questions along the way, don't hesitate to drop those into the chat. We'll try to hit as many of them as possible as part of today's conversation. To the extent that we don't get to your questions, we will make sure to reach out and don't hesitate to reach out to our team. If you have questions on topics maybe that we don't touch on or we don't cover, we're happy to have those conversations after today's call. And really get into the weeds to the extent that you're getting questions from your clients or have questions yourself about the market and the economy. So with that being said, I will say the agenda for today looks at this idea of normalization. So we'll talk a lot about the fact that coming out of COVID and really going through that post-COVID period. And for those of you that have been with us in the past, you've heard us talk about the fact that it really hasn't been a normal market environment. So what we're seeing today and what we're talking about today is this idea that we're returning back to normal. So with that being said, we will get started. But before we get into that normalization conversation, we do want to start with one topic that has been near and dear to our hearts for a while. And one thing that we think is going to be terribly important really over the next few years. And it's this idea of AI and maybe why it matters and how it matters. So Scott, maybe kick us off here and walk us through what we're seeing and why we think it's important.
Yeah, thanks, Austin, and hi everybody. Look, this is the one slide in the presentation that is not a return to normal. Although it probably is the way that normal is going to be defined over the next decade or so. And, you know, this AI revolution that we're in the middle of, and actually, quite frankly, probably in the early innings of, is one of the most important things that we've seen in markets over the last 25, 30 years. And the reason is that it's a large technology revolution, and technology revolutions have the power to push the supply curve to the right, to drive productivity gains. And productivity gains is just doing the same output with less workers, or the same or more output with the same number of workers. And the only way you get those is with large technology shifts. Last one we saw obviously is that the mid to late 90s with the internet and the PC revolutions there. But this is to get these large scale productivity enhancements, you need these types of technology developments. We've been talking this for about a year and a half now, frankly. But we are now starting to see some of these headlines that I put up on the board, and we've got I grabbed a couple at random, but there's a bunch of examples of this right now of companies saving money using this technology, of people streamlining their processes, streamlining their production processes. This is, and we are just scratching the surface on this stuff. So obviously supply curve going to the right means that is upward pressure on growth, downward pressure on inflation and interest rates. It is the most magical elixir you can get in economics. It's really hard to get. Government can't give it to you. You've got to get it from the private sector, and specifically from technology revolutions. So just understand that this is something that we think is going to continue to drive markets, just like the last one did in the mid 90s for years to come. And so this is just a train you have to get on board.
Sky, you talk about this idea of it being early innings as we talk about the AI revolution. I think what's important, though, is the fact that we are starting to see some of this broadening out, right? You see Oracle on the screen here. Obviously, the technology industry and sector really has kind of been the first wave, if you will. But we're starting to see that broaden out to other sectors or other areas of the economy, right?
Yeah, look, I mean, just like the last technology revolution we had, it starts in the tech sector. It starts in the most obvious places. But these things do broaden out. So Amazon wasn't really a tech company back then. Pets.com wasn't really a tech company back then, and there's going to be some fraudy stuff going on with this at some point as well. Let's be clear. But the vast majority of companies that are going to be surviving in 10 years from now are going to be using AI in some way. They're going to be using it to save money. They're going to be using it to drive productivity enhancements. Just like some of the examples that I put up here about just those types of things. So broadening out into healthcare, into industrials, into other sectors of the economy. I mean, one of the most important things to watch for. We're certainly spending a lot of time on it here.
Awesome. Good stuff. All right, Scott, now let's get into the conversation of kind of this return to normal. And we'll look at a number of different charts and graphs as we go through this section with this idea that, again, we lived through this COVID period where we endured a global pandemic, right? You saw a significant pullback in a number of different economic indicators, economic data points. Retail sales is a great example. Right here, we're looking at same store sales and year-over-year growth. And what you see, obviously, is 2020, that number took a massive hit, right? 2021, 2022, 2023, all of a sudden it bounces back significantly stronger than really anything we've seen over the last 25 to 30 years. But now what you see as we get into 2024, you're back into that normal range, right? Historically, normal same-store sales growth has been anywhere between 0 and 5%. Look where we are right now, right? Back in that range. And that's something that we see in a lot of different places. Scott, this looks at kind of, again, the consumer side from a sales standpoint. If we talk about labor markets, you're seeing a lot of the same data, right?
Yeah, you are. And look, when we talk about labor markets, we have to kind of broaden out the way we think about it. I mean, obviously we got a blowout payrolls number last week, but that really sort of secured this soft landing narrative and that we've been harping on for months and months now. But that's just one number. That's one way to look at the employment situation in the United States. So I do like to look at multiple measures of employment and just sort of like to see where they're all what they're all doing. All of them are going to rhyme, but they might be telling you different things at different times. And so here what we're looking at is again a bunch of different ways to measure the employment situation in the United States. Not one of them is the exact right one, but taken all together, they're going to give you about the right picture of what's going on. And this is a picture of normalization. You're going to see a lot of charts that look like this, but it's important. It's important because of what it's going to do to the Fed reaction function, as well as just the economic outlook going forward.
So, Scott, that's kind of labor market more broadly, but now let's maybe dive in a little bit deeper into labor costs, right? And you're seeing, again, same type of story there as we get back into that normal environment.
Yeah, and I like to look at unit labor costs because what they do is they take wages and they essentially adjust for productivity gains. And so it's one of these, you don't mind paying workers more if they can do more work, if they can be more productive, they can produce more value. And so unit labor costs intentionally to try to take account of the fact that productivity gains happen in the economy and basically normalize for that. And what we're seeing here is, okay, so what you didn't want to see, what the Fed did not want to see, is that spike that we saw, in basically 2021, 2022, because unit labor costs can lead to wage price spirals. The Fed is definitely scared of that, as we all know from the 70s. And so avoiding that and getting this unit labor cost number back down to kind of, again, this normal range where we generally sat is an incredibly important piece of the puzzle for the Fed to be able to start easing.
Scott, you talk about the Fed starting to ease and really the topic that's been at the forefront for some time now as to whether or not they're going to be able to start easing is this idea of inflation. And I think this first chart that we're looking at really speaks to the breadth of inflation. So for those of you maybe that aren't as familiar with what we're looking at from a breadth perspective, is there's a number of different segments that go into the inflation calculation, whether that's healthcare costs, whether that's housing costs, whether that's food. There's a number of different things that go into that. And what we've done here is we're going to look at each of them individually and figure out what percentage of those segments is actually above that 2% annualized rate. And you can see as we worked into 2021 and 2022, over 70% of those segments actually were seeing inflation above that 2% annualized number. Fast forward to today, roughly 45, just under 50% of those segments are right around that 2% number that, again, is kind of that sweet spot for the Fed. So the idea that the breadth of inflation is coming down is extremely important, which, Scott, then goes hand in hand with the idea that inflation expectations are coming down, right?
Yeah, I mean, look, of course, the Fed was happening, cares what's happening with realized inflation. But they also care deeply about inflation expectations remaining anchored. You hear this term anchored inflation expectations a lot when Fed folks talk. That just means that we don't want things running away and getting out of control in sort of a feedback mechanism. And so one way to gauge the market's inflation expectations is through a tradable instrument like an inflation swap. Inflation swap's a derivative instrument that you can basically back out what the market's expectation for inflation over a given period of time is. But right here we're looking at what the market's expectation for CPI is, and CPI inflation is over the next 2 years. And I just highlighted the box, like that's kind of like, this is sort of normalish, like 1.5 to 2.5% is about where the market typically kind of hangs its hat on where inflation is going to realize. And we're back right in that range again today. This is a very important piece of the puzzle, again, for the Fed to make sure that inflation expectations remain anchored.
So Scott, we talk about kind of that return to normal environment. And again, if we actually look at a number of different inflation measures, what you're seeing is those trends continue to move us in the right direction, which, as we've talked about, kind of gives the Fed cover for that easing cycle to really kick off.
Yeah, and again, and under the rubric of not just looking at one piece of data to try to tell a story with, we're trying to look at a bunch of different ways to analyze the inflation trends that we've seen in the economy. We're looking at, we looked at wages, we looked at the employment situation, we're looking at inflation breadth, we're looking at inflation expectations. You add all that stuff up together, and this is a phrase I've said many times over the last few months. But this book has been written. We are just now reading the story, and this story is inflation is back in the bottle. The genie's back in the bottle. Like, it's okay. And this is something that's it's clear from many of these trend measures you're seeing. It's clear if you look at headline CPI, core CPI, trend measures, like whatever you want to look at, they're all pointing you in the same basic direction, that this inflation problem has been whooped and is mission accomplished.
So Scott, if we talk about the idea that inflation has been kind of taken care of, then we go into that conversation from a Fed perspective is, okay, what does that mean from a rate cut perspective as we head into 2025? Obviously, we've seen the first set of rate cuts here last month. Now what you're seeing, though, is a path forward. What does that look like? And what does that mean? What is the Fed trying to fight off at this point, given the fact that inflation is really under control and they no longer have to worry about that? So, Scott, maybe explain as to what we're looking at here, but also what that means from a Fed perspective.
Yeah, I mean, look, what they're trying to fight off isn't inflation anymore. And that's important because not only has inflation gotten back to normal, but the way the Fed operates and the way the market considers the Fed to be operating, the way we should consider the Fed to be operating, is also getting back to normal. If we define normal as most of the last 25 years, and what that means is when growth decelerates or when employment gets bad or the outlook worsens, the Fed's going to step in and try to ease conditions. This brings in this idea of a Fed put. The Fed put was not in play when inflation was the thing the Fed was fighting. So if inflation is the enemy, the Fed can't step in and lower rates if things start to turn bad. This is what happened in 2022. The Fed really couldn't come in and save the day. But now with inflation being whooped and Powell stating very clearly that the labor market, he's much more worried about the labor market, even though he says the word's balanced. You can tell he's much more worried about the labor market and further weakness being quote unquote unwelcome there than he is about a future inflation. And that translates into the Fed put being back and being the strike price being fairly close to where we are today.
Awesome. No, that's good stuff. And with the idea that we're talking about kind of that labor market and how that then affects the consumer, probably makes sense for us to really dive into the strength of the consumer and whether or not we're still seeing a consumer that's maybe as strong as we've talked about for some time now. Again, for anybody that's been with us in the past, we've talked time and time again about really just the underlying strength of the consumer. And we'll highlight some of those charts again today and really have that conversation, because I think it's something that we definitely have to pay attention to. And again, if you're looking at the consumer, you also have to pay attention not just to the debt side of the equation, right? You have to pay attention to the wealth or the positive side of the equation, if you will. And what you see over the last, let's even call it 5 years at this point, is you've seen a significant outpacing of the debt component with that wealth component. So this idea of a consumer balance sheet continuing to be healthy is something that we want to highlight, Scott, and really dive into as we look at a number of different measures over the next couple slides. I think this next one is pretty telling, is if we're having that conversation about kind of the overall consumer wealth, liquidity and just how flush they are with liquidity is extremely important.
It is. Look, I mean, like you don't get recessions like we had through COVID, where basically consumer liquidity goes up by $6 trillion, and that's just what happened. So if we consider liquidity to not just be money in savings accounts, look, the savings rate is somewhat important, but it's also misleading because it doesn't tell the whole story. So like people put money in savings accounts, they put money in checking accounts, they put money in money market accounts. I'm not even talking about money they have in their investment accounts that are used to purchase mutual funds, ETFs, or other stocks or other investments. I'm not even talking about that stuff. I'm talking about basically cash, like things you can get in cash. There's $20 trillion of it out there right now. It's an enormous sum of money, and it's not being depleted either. You can see like it's kind of gone sideways here the last year or so. And so just understanding that this is a consumer that is overall, like writ large, pretty flush. Should be an important starting point to understanding its basic health.
Scott, that's a great point. I think what's important though is we also consider maybe the other side of the equation in terms of what are the risks, right? And we've all heard them. I think one that continues to pop up, at least questions that we're getting internally here, is okay, credit cards. We've started to see balances go up. We've started to see delinquencies go up. Right? If you look at either of these two charts, whether it's 30 days past due, 90 days past due, okay, all of a sudden what you're seeing over the last year or two is movement in a direction that I would think none of us really want to see. So it's a question of, hey, is this, are we really starting to see something that's going to break the consumer? And Scott, I think one thing that we'll talk about over the next few slides is, hey, let's make sure we're not getting fooled by a very short period of data over the length of an entire data set. And I think what you see here, right, is, hey, we're looking at 5 years of data, but let's start to back that out, right? Let's start to look at 25, 30, 40 years of data. And maybe that story looks a little bit different. Is that fair?
It is. And so, we want to do two things. One, yes, you need to understand the data in the context. So just looking in a snippet, like it can be somewhat misleading. It can be, there's a term for that. It's called chart crime. So you don't want to be accused of chart crime. So, wherever possible, like just show the maximum amount of data possible. Like this is all the data that exists on consumer delinquency. It's all of it. I wish it went back further than 1984, but it doesn't. That's just what it is. But this is the delinquency rates for all consumer debts, and it includes credit cards, which is generally the riskiest. But it's auto loans and mortgages and credit cards and all of it. So overall, you can take a look at this picture and say, yeah, it doesn't look this doesn't look terribly worrisome, but maybe this masking something underneath the surface with respect to the credit card side especially.
So Scott, if we look at that and we say, okay, consumer loans in general really aren't that bad. Let's look under the surface. It doesn't actually tell you much different if we actually look just at credit card delinquencies.
Yeah, not so fast, right? I mean, like this is the gold line is a credit card loan data. It doesn't quite go back to 1984. It goes back to like 1990 or so. But credit card delinquencies are they are that's where they are. It's the red dotted line is where they are today. You can see it's basically above, the delinquency rates are above most of the post GFC period, obviously far below the period from 1990 up until the great financial crisis. You can say they're in the neighborhood of average. And by the way, I don't want to be Pollyannish about this. Like, I'm not saying that this can't be a problem. I'm saying if that trend keeps going up like that and for another few years, like, yes, that could end up, delinquency rates on credit cards could actually end up being something that we really need to have a serious conversation about. I'm not saying it can't be a problem, but I'm saying it is definitely not a problem right now. Like, I mean, all you got, like, just look at this entire series. This is not, the credit card delinquencies are just not an issue right now. But like overall consumer delinquencies on loans, all types of loans, not an issue right now. So I'm not saying it can't be, but I am saying it's not.
Scott, that's a great point, and I think that kind of brings us to the next data set to say, okay, if delinquencies aren't technically or aren't really a problem right now, maybe it's debt service, right? Interest rates have gone up. Maybe the idea of servicing your debt has become a lot more challenging. This is a chart that we've seen over the last 3-4 years at this point. It's this idea that the debt service has gone up pretty significantly kind of post-COVID, right? It's become a lot harder for consumers in theory. Based on this chart, you would think it's become a lot harder for consumers to service their debt. Again, this is one of those kind of chart crime conversations, because if we back it out, Scott, that's not really a thing, right?
Nope. I mean, look, it's a heck of a lot worse than it was in March of 2021 when the government was giving everybody money. There wasn't any debt service to be paid because nobody's taking, like, nobody's using a credit card, take the money that the government gave you to buy everything with. And that is what it is. I'm not making a judgment on whether the government did a good or a bad thing with that. But it is the reason why credit card usage went way down. It is the reason why debt service ratios like this went way down. And to be clear, debt service ratios are, how much, like, relative to somebody's income, how much does it cost them to service their debt? Well, like, what does it cost to pay the P&I on a mortgage plus the credit card, balances plus everything else. But it's all relative to, importantly, it's relative to income. So you can't just look at these things as like how much credit card debt is there, because I got a suggestion for you. It'll be higher next year than it is this year. It'll be higher in 2 years than it is a year from now. It'll be higher in 3 years than it is 2 years from now. That's one, because the population is growing, two, because the money supply is growing, three, because people just end up spending more money, and that's just the way that the nature works. So if you look at like long-term charts of these things, they always go up. So you have to find a normalizing factor, and normalizing debt service by somebody's income is the most direct way to assess whether it's a healthy amount of debt and a sustainable amount of debt or not. Yeah,
no, that's a great point, Scott. And as we continue that conversation on the consumer, and right, are they spending too much? Are they making enough for their spending? I think this is a chart that really kind of hammers that point home. It's this idea of, what are we seeing from a spending power perspective as that relates to maybe income that they're getting or payrolls. And then what does this chart tell us in terms of should they be able to spend going forward?
Yeah, I mean, this is one of the most important charts to assess, like not today's spending power, but tomorrow's spending power. So total payrolls is a pretty simple calculation. It's just number of people that are working times how much are they getting paid times how many hours are they working. That's basically it. Like just kind of total income of the U.S. economy for wage earners. And if you wonder, if there's any wonder about why we had an inflation problem in 2020 in 2022, look at those numbers coming through like late 21 and early 22. We were printing like 15% increases in spending power. So of course, when people in the United States especially get money, they don't tend to save it. They go and spend it. And so if you got people's nominal income growing by 15% on a year-over-year basis, they're going to go out and spend that money. Of course, they're going to drive prices up. And by the way, the last 3 years, when we've seen it go back down to this kind of the pre-COVID average of around 5%, it's also not a surprise why the inflation problem is over now. And so this total spending power is an important gauge not only of inflationary pressures, but also of corporate revenue outlooks and overall the health of the economy. This is future spending power, and it's really healthy right now. Totally normal.
Scott, we've talked about spending power, but also that kind of dovetails into this idea of income. And I think one thing that's super interesting is if you actually look at kind of real income, right? How has income increased over the last 3, 4, 5 years if you adjust for inflation? I think what's super interesting is you've actually seen all income levels, whether that's the lowest or the highest, actually see income gains over the last 5 years. And again, as our good friend Rasheed Wallace would say, in this case, the numbers don't lie, right? Again, we all may know people individually who may not be doing better. But as a whole, as an economy, what we're seeing is, generally speaking, everyone is doing better across all of those income levels in spite of the inflation numbers that we've seen. So I think that's something that you really have to take into account is, yes, inflation was bad, but as Scott, you just talked about with some of the payroll increases, actually what you've seen from an income perspective is actually even better and even higher than those inflation numbers, which is crazy to think about. But again, that's where the numbers actually give you the data that's extremely important there.
Cumulative wage gains were larger than cumulative inflation, as weird as it sounds. It doesn't feel right, but it is right.
So Scott, we'll maybe transition into a conversation around what this all means for markets. And we'll start with kind of the Fed and kind of rate cuts and what we see from an expectation standpoint. And I think what's interesting is that a lot of folks really get into the conversation about, the Fed cutting rates really means a recession and oftentimes accompanies a recession. And I think what's interesting is that doesn't necessarily often have to be the case, right? If you actually look, there are periods, the mid 90s, late 90s being a great example, when the Fed did cut rates in that soft landing scenario. I think if you look at periods where they cut rates and the actual rate cuts were significantly higher, right? There were some exogenous factors that were at play, whether that's the tech bubble, whether that's, 2007, 2008 great financial crisis. Like, there are times when, yes, the Fed did have to cut over and above maybe what was initially expected. As we've just talked about, a lot of the data that we're seeing as of today would not suggest that there are going to be any exogenous kind of recessionary factors in play. If that's the case, kind of that soft landing scenario becomes a little bit more of a base case than it does kind of an outlier. Is that right, Scott?
It is. Look, I mean, obviously, everybody likes to talk about the market. The market's never right about the Fed. Well, they are but when there's no recession. They're clearly not, though. Like if we get a recession, then the Fed's prediction about how much the Fed's going to cut is going to look hysterically terrible. But we haven't seen a recession coming for like this entire cycle, as you guys all know, and we still don't see one in the offing outside of some exogenous event happening. And so we do think around 200 basis points of cuts. Fed funds around 3% at the end of the day is going to be about the right number, and that's when the Fed, you can just see from the chart, like when there's no recession, the market gets it about right.
Yep. That's a great point, Scott. And you mentioned this idea of kind of the 3% kind of long-term rate being kind of that normal rate, maybe that the Fed's shooting for. Let's take a step back and let's help folks see, okay, so where does that number actually even come from? How should we get a reasonable estimate of what that rate should be? So Scott, walk us through. We've got a couple charts here in a row that are going to kind of give folks the pieces for how we get to that number.
Yeah, look, I get asked somewhat frequently about like, our rates, is the 10-year rate right, or is it too high, or is it too low, or like but if you're talking about interest rates, you have to have a framework within which you're operating. You have to have a way to think about the problem from a really just sort of first principles fundamental standpoint. And so I'm going to just take a couple of slides and show you at least how we think, or how I think about kind of coming up with like what's about the right interest rate for the economy, given the things that we know today. And so you always want to start with this thing called R star, which is essentially the inflation adjusted natural rate. Just like where Fed funds would be that is neither accommodative nor restrictive in the economy. This is probably the fuzziest part of this argument, but it's a necessary starting point because we have to know kind of what that sort of not accelerating but not decelerating rate of interest is in the economy. Right now, the best estimates are around 1%. So we'll start with 1% as a starting place. From there, we need to add in inflation expectations. And so if I'm talking about a 10-year rate, I want to look at 10-year inflation expectations. Looking back again, this is all the data that exists on this contract, but these are longer term inflation expectations that go back over a decade. And right now that sits right around 2%, has sat around 2% for a couple of years now. That is a fairly typical reading for this. And so we got to add into that neutral rate. We got to add in inflation expectations. So we got 1% neutral rate, 2% inflation expectations. And then if we're talking about a 10-year rate, we have to add in this thing called a term premium. It's just like, how much money do I need to get compensated? Like, how much extra compensation do I need to tie my money up for 10 years rather than for overnight or for 3 months or for 1 year? And so any essentially additional term that I have to tie my money up for, if you ask me to tie my money up for that amount of time, I want to get paid a little bit for that. And so, again, there are ways to estimate these things. I just listed all the sort of here's a bunch of different models that, kind of fancy math models with a bunch of Greek letters in them. But this is just different ways people estimate what that term premium should be. Right now, it's in the neighborhood. If you average all these things out, both long-term and short-term, it's right around 50 basis points. So we'll call it generally 50 basis points. And so, you have to add that onto the number. And so, if you take that 1% neutral rate plus that inflation expectations plus that term premium, you end up with this very simple model of what a 10-year rate should be, and that's the line in green. So I took the line, I took what that model would suggest is the kind of quote unquote fair value for a 10-year rate, and just compared it against what the 10-year rate actually was. And you can see, going back, pre-COVID, it was an excellent model. COVID screwed it all up, like it did everything else in terms of econometric estimates. So I just sort of take that entire period in blue and just like throw it out the window because like nothing made sense during COVID from a math sort of and like a statistical standpoint. But otherwise, like this is this model like is it's super simple, but it provides a framework and a way to think about the problem. And the answer to that is like somewhere in this 3.5% to 4% range is probably about where we should sit in 10-year rates right now. It's about where we are right now. It's it's not again, I'm not trying to be perfect with this. I'm just trying to get you guys like a framework to how do you think about a problem like this, and what's about the right answer? Like knowing that there's not a precise way to answer this, but 3.5%, 4% is about the right answer, and that's about where we sit today. So we think that rates are in the neighborhood of right. They're not wildly high, they're not wildly low. By the way, there's no expectation for them to change a lot from here, which is important. We think this level of interest rates between 3 and 4% should prevail for a while. We'll see as things change on the margin. But all the information we have today suggests that this framework would suggest that rates are about right now.
So Scott, if we're talking about kind of that 10-year treasury number, then the question often gets asked, so why is that important, right? Like we talked about the Fed funds rate, we all know why that's important. But if we're talking about a 10-year number, then the question is, so where is that relevant to, Main Street investor or Main Street, consumer, right? Well, what we've seen and what, hopefully a lot of folks out there see as well is actually the 30-year mortgage rate is often tied pretty closely to the 10-year treasury. And what's really interesting here is if you look historically, again, that concept of normalization, what you see is you're starting to see kind of a normalization of that spread come down, right? Interest rates on mortgages were significantly higher in terms of the spread above that 10-year rate than really they've been almost at any point in the last 25 years over the last 2, 3, 4 years at this point, right? So what does that mean? Well, if you start to see normalization in the mortgage kind of side of things, Scott, that maybe tells us that we've got a refi wave coming our way, right?
Yeah, and this is something that, if you guys have been listening to this for a while, we talked about this like pre-COVID, or anybody even know what the word COVID meant. In 2018, 2019, we started talking a little bit about this. And to be clear, this is not a 2024 story. But if you want to think about a story that and sort of a theme and a tailwind that could be pretty powerful next year, it would be this. So these blue bars are how much different is the prevailing mortgage rate from basically the average existing mortgage rate in the economy. And when it's negative like this, that means that basically mortgage rates are the mortgage rate you get today is much higher than the mortgage rate of existing rates. So basically, there's no incentive to refinance with mortgage rates much higher than your current rate, obviously. But the point of the last slide was mortgage rates today are 250, 300 basis points higher than the 10-year rate. There's probably between 1 and 1.5 percentage points too high, relative to where they should be. So if the 10-year didn't move from here, we expect mortgage rates to fall by between 1 and 1.5 percentage points over the next 6 months or so. And that kind of activity could have a twofold effect. One of them, the most obvious and the most obvious implication is that this spreads comes much narrower, and there can be a lot of folks that took mortgages out over the last 4 or 5 years that will have an incentive to refi, and that is basically fiscal stimulus. It's basically private fiscal stimulus. All it is just more money in people's pockets. And so that the reason why we talked about it 5 years ago was just for that reason. We were trying to point out that if you get this refi wave, which we did end up seeing in late 19, early 20, that can actually act as a pretty big fiscal stimulus that nobody talks about. We think that we could see that coming in 2025 as well. Again, one of these things that nobody's talking about yet. We think they will next year. But that's sort of the first order effects. The other effect, though, is interesting and really impossible to measure. But something I think interesting to think about is the impact it could have on labor mobility. So if you think about like anybody that's like locked in, people locked into a mortgage, and basically locked into a house, and if you're locked into a mortgage in a house, you're locked into a location, and we all know what the trends are with work from home. It's not going up anymore. That's a one-way train on the way back to the office, and so that's actually freeing up of people to be able to refi out of their, basically get out of that 4 or 5% mortgage and have the ability to move, have the ability to do something different. Makes for a more flexible labor market. More flexible labor market is always a better labor market. Just ask Europe, the most inflexible labor market in the world. And they have like chronic employment problems and chronic all sorts of other problems associated with that. But the point is like a knock-on effect to this dynamic is something that we haven't had to really deal with in this country for 30 years. And it's basically people locked in their mortgage, locked in their houses, locked in their physical location. That actually could be easing as well. Again, not a story for 2024, but I think possibly an important one for next year.
No, that's a great point, Scott. We've now talked about fixed income markets. let's transition over to equities, right? What is loosening monetary conditions? What does that mean from an equity standpoint, right? We know what it means for fixed income, but let's look at what it means for equities.
Yeah, for equities, I mean, just so tightening or loosening monetary conditions just means it's pretty obvious. Tightening monetary conditions is the Fed's raising rates, or they're engaging in QT. They're strengthening their balance sheet. Loosening monetary conditions are the opposite. They're lowering rates, or they're engaging in QE and increasing their balance sheet. And generally what we've seen over the last 10, 15 years is when there is tightening money, that tends to be good for basically the Mag 7. So think mega cap tech. So when the Fed is tightening monetary conditions, they're basically making it harder to grow. They're making it harder for the economy to grow. And what that does is it puts a premium on growth. And the companies in the world that have the ability to grow the fastest without really needing sort of the underlying economy to be doing anything are those mega cap tech names. I mean, it doesn't look whether or not people are the economy is growing well, people are still going to go to Google to search, and they're still going to use Amazon. They're still going to do stuff on Netflix, all those things. They're just not as tied to the economic cycle as many other names. When they have basically a growth premium built in, so when the growth is scarce, those names tend to do well. So it's just those mega cap tech names. But when monetary conditions are loosening, that actually that should increase inflect growth upwards for the economy. Then that's the time the rest of the stocks can shine. This is their hour, because if you have an inflecting upward growth economy, which we think we're actually going to start to get, that's the time you can get the broadening out. So people don't market just doesn't broaden out because it wants to broaden out because it's bored with the Max 7. It broadens out because there's a catalyst. There's a reason for these other names to start getting some love. And I think the combination of these other names and other sectors figuring out how to use one, the AI technology, but two, kind of having basically now they're going to have the Fed at their back and growth at their back, and that's the catalyst. That's the growth catalyst. That's the earnings catalyst. That's the revenue catalyst that they're going to need in order to get a broadening out market. It just doesn't happen of its own volition. It needs this catalyst, but this loosening monetary conditions is one of those preconditions that can be pretty important towards that.
Scott, if you talk about this idea of broadening out, one thing we're not saying is that the Mag 7 companies will necessarily start to,
because they're amazing companies and they're doing amazing things. This is not it's not the NASDAQ from 25 years ago. Pets.com is not in the Mag 7. These are great companies. It's just they may be outshone for a little while by maybe some small caps or by some value names or by just something not called the Mag 7.
Yep. No, that's a great point, Scott. So if we look at, again, kind of this idea of returning to normal, here's another chart to add to that list, right? You look at corporate revenues, right, all the way back to 1970. That's over 50 years of data. What you start to see is you're getting back into that kind of normal scenario, right? The average over the last 55 years is about 2.5%. Look at where this chart sits as of today. It's smack dab in the middle, between 0 and 5% on a year-over-year basis. So the fact is, you're seeing kind of that return to normal scenario across a number of different aspects, a number of different data sets, corporate revenues being yet another one. And I think, again, Scott, to your point, going hand in hand, the ability for that to start to broaden out starts to become really interesting as we talk about kind of growth prospects heading into, not just the fourth quarter, but really 2025 and maybe even 2026. Which then kind of dovetails back into that conversation we've had for a couple quarters now around, okay, maybe do we see some similarities between any time periods historically? We've talked about the fact that, what we're living through currently with the AI revolution maybe feels and looks a lot like that internet revolution. And the chart on the left really looks at kind of this idea of comparing ChatGPT when you saw kind of that takeoff, really call it, end of 2022 with really when Netscape Navigator came out at the end of 1994 and what that meant for the NASDAQ, right? Look at how closely those two charts kind of track one another there in the mid 90s for that point. Again, what we've done here is we've created a shorter chart on the left, right? To give you a sense of just how close those two track together, but then blown it out on the right to give you a sense of, okay, maybe we've got a little bit more runway than we all want to admit. And what you see there is, even following Chairman Greenspan's comment about irrational exuberance, right? This idea that things were maybe out ahead of themselves. You had close to 5 years worth of a run on top of that. Now, again, we're not making the case that we've got necessarily that long, but don't sit here and think that just because it's been running for, let's call it the last 2 years at this point, that it's got to end next week, next month, next quarter even. I think another piece, and Scott, I know we've talked a lot about this in the past, is there's a pretty marked difference between the companies, and you've kind of referenced it a couple times now, the companies that were part of that irrational exuberance in the 90s, and then what we're seeing today. The chart on the right is Cisco in the 90s, right? Look at the green line, that's their earnings. Look at the blue line, that's their share price. Pretty wide divergence between the two. Chart on the left, that's NVIDIA over the last, call it 6 years. Their earnings have actually led their share price higher. So you're seeing a very different environment for companies that are maybe leading some of that, some of that revolution right now, as opposed to maybe even some of the names that you saw in the mid to late 90s from a tech bubble perspective. Scott, anything else that we're missing on this slide or that you'd add in here?
No, I mean, like it just, I mean, this is one piece of the evidence. Like the one thing I get asked a lot is like, are we in a bubble? And the answer is categorical, of course not. And again, just like a few minutes ago, like I'm not saying it can't, like we can't get there, but we're nowhere close to that right now. Like this is a rally in these stocks that are supported by rising revenues and rising earnings, and is supported by sort of the economic story in the backdrop where we know is going on. If this thing is as important if the AI thing is as important as we think it is, then these are very well supported valuations, very well supported stocks. Again, not saying it can't get to a bubble territory, but there's just no cause to think that way right now.
Yep. So if we talk about kind of that valuation metric, Scott, I think there is another similarity. If we start to look at kind of earnings yields and what that means and what that means for maybe even asset allocation conversation.
Yeah, I mean, sometimes people like to think about this comparison between 10-year yields and earnings yields on stocks is sort of like which one's the better deal. And that's, that has been somewhat the case of people thinking about that for the last 20, 25 years. But I would harken back to think that, hey, just because earnings yields and treasury yields are in the same neighborhood today doesn't mean the bonds are a better deal. Doesn't mean that that's the place you be. Because again, if the 90s are the right comparison set, which we still think it is, we're kind of in that same place as we were back then. That can support a pretty good run in stocks. And by the way, would you rather been in stocks or in bonds from 1990 to 2000? It's not even close. So yeah, you can clip a nice safe 4 or 5%. You get steamrolled if you get the absolute steamrolled if you get the equity rally that we think is coming.
And that really goes into this graph right here, Scott. This looks at really bull markets over the last, call it 90 plus years at this point. And what's really interesting, if you actually look at kind of the average or kind of the normal, regular, however you want to define it, bull market over that period, that's really that kind of black dotted line that runs through the middle there. And really that black solid line, as you can see along the left-hand side, that's where we sit today. And I think what's really interesting is if you just look at the median duration or the median magnitude, we actually still have a decent amount of time that we could spend in this bull market that we're currently in, right? Median duration would suggest we have close to a year at least. Magnitude, we've obviously got room to run there as well. And I think what's interesting is a lot of folks tend to look at it as, okay, we've been in this bull market for 2 years, 3 years. What's really important is not just looking at where we are today, but where we're going. And I think a lot of what we've talked about would suggest that again, maybe there's more room to run, and history would tell you the same thing. Scott, I think maybe one last chart before we take a couple questions is, okay, we've talked about all of this. What should we be focused on if we're actually entering a cutting cycle? We've talked about that being a tailwind. How does that impact the economy? How does that impact the market?
Yeah, so this answers the question, like, what happens after the Fed starts cutting rates? And again, like probably one like that, the clients are starting to ask, and because obviously the Fed started cutting rates, and the answer that the sort of the larger answer is this top chart. When after the Fed starts cutting rates, the average the return on the S&P 500 is 0. That is misleading. as false advertising, that like that's fake whatever. Because what you have to do is you have to bifurcate that. You have to say, like not all cutting cycles were made equal. So if the bottom chart like says, listen, was this cutting cycle during a did it precede a recession or did it not precede a recession? And the stuff in the boxes are cutting cycles that did not precede a recession. And obviously, all those times the market did pretty well. So the Fed cuts, the market does pretty well. Guess what happens to the market when we enter a recession? Like it goes down. It's the only time it goes down like materially is when we get a recession. So like it really that like what happens after the Fed cuts depends on your call. Depends on your economic call. Are we gonna hit a recession or not? If we're gonna hit a recession, then get out of the market. If we're not gonna hit a recession, it's like probably some like this is just further fuel on top of this pretty nice little fire that we've got going right now. And obviously if we don't think there's a recession coming, so we're still pretty optimistic about this. If you do think a recession is coming, different story, but we just don't see it in the data right now.
No, that's a great point, Scott. So if we look at kind of the takeaways that we've got while we kind of aggregate a few questions here at the end of the call. One, right, this concept of normalization, right? We've talked about it time and time again. There's a number of different ways to look at it, but we are getting back into kind of that normal market environment, that normal economy where those leading economic indicators that we looked at for the last 4 years that maybe didn't actually work at all, maybe now they start to carry a little bit more importance, a little bit more value. One, that's important for us to look at. Two, and I know we've talked about this time and time again as well, like just you can't underestimate the power of an employed U.S. consumer that's actually in pretty healthy financial shape, right? They have a job. They've made money over the last few years in spite of inflation. They're spending money, like all the things that we talked about. You can't forget those kind of key pieces of data. And then the third piece, right, and we just made the comparisons to the mid-90s. Like there's a number of different things that would suggest that there may actually, continue to be room to run as we head into, like I said, not just the fourth quarter of 2024, but really 2025 and beyond. So with that being said, we do have a few questions that have come through. Scott, the first one, and we probably should have known this. Hey, you guys didn't talk at all about the election that's coming up in less than a month. What should we be thinking about the election? How does that have an impact on the market? Should we be worried? Should we have an optimistic outlook? What's Horizon's view there?
The president just doesn't matter that much, guys. The president's one person and the economy is massive. And so in terms of markets, like in terms of policies and like parts of what may win and what may lose and things you want to invest in or things you want to avoid. Yeah, like on the margin, like it can make some difference. But it's like you're betting on the U.S. economy. You're not betting on a guy or a gal. And so like that, that lesson should be fairly clear. Like anytime you try to trade your politics, anytime you try to trade your politics in the last 44 years, like if you didn't invest because you didn't like the person sitting in the Oval Office, you were wrong every time without fail. So like don't make that mistake. But the only other thing we'd say is like, so the expectation is if there's not one letter across all three, if it's some sort of divided government, then the market can easily live with whatever outcome it'll be. Again, it might have implications for like where you want to invest, how you want to invest, what some nuances there, but not whether you want to invest. If it is a sweep on one way or the other, maybe some other things again we got to try to figure out. It's whether it's taxes or regulation, or tariffs, whatever it is. I'm not saying there's not going to be things we need to figure out. But the decision to basically get in this market, especially with the AI tailwind that you got, should not come down to whoever it is that happens to be sitting in the Oval Office. They just don't matter that much to the economy or to markets.
Yep. Scott, over the last at this point, a year now, we've seen escalation in the Middle East. Is that something that we should be worried about? Is that something that's affecting Horizon's views on the markets? Is that affecting asset allocation, portfolio selection, those types of things?
So this is a good question, and like I'm gonna give probably an unsatisfactory answer, but it's like as of right now, probably shouldn't be doing a lot because the history has told you that you need to fade every single one of these flare-ups in the Middle East. So you fade or you don't pay attention to the geopolitical situation and coming out of the Middle East. One of the reasons is because the way that can actually impact the U.S. economy or global economy is basically through oil prices. The U.S. now is the marginal producer of oil in the world. We are not an importer. We're not reliant on foreign oil and have not been for years and years and years. And so and also you made this point earlier this morning when we were talking about this. In the Gulf War, the energy complex was, or energy stocks made up 14-15% of the S&P 500, and now they're 3% of the S&P 500. And I think I said call them something like a screaming midget or something like that. They were super loud, but they don't matter that much. And so just I'm not saying again that there's no state of the world where Middle East geopolitical tensions could impact the U.S. markets or markets in general. They certainly can, especially if this thing really escalates and something really hot that could make a difference. I'm just saying, like, that history has taught us that we probably will be better served by looking through it, but it is obviously very tenuous and fast moving. We're watching it really closely, but not necessarily needing to do anything right now.
Scott, last question that's come in that we'll have time for today. We've seen a massive bump in China, emerging markets over the last few weeks of the third quarter. Is that something that we would expect to continue? Is that something that has changed how Horizon is managing portfolios? Like, what should we expect out of China as we head into the fourth quarter?
So, I mean, again, I got a really timely and good question. Y'all are doing well with these. It is, China's complicated. And so China is in the middle of a balance sheet recession. They have massive, we all know the demographic problems. They have massive amounts of, they have a huge savings problem. They have no consumer confidence. And balance sheet recession is just when companies and people would rather save and pay down debt rather than spend. And this happened in Japan in for 25 years. It happened in the United States after 08. Consumer deleveraging, private sector deleveraging is a really bad force for an economy. The only antidote that's ever been successful in recorded history is large scale government spending to basically take the place of the private spending that goes away. And China thus far has basically said, no, we're not going to do that. We're not going to break out the fiscal bazookas. And they're suffering the consequences of that right now. They're kind of just death marching into this balance sheet recession and bad economic times. And the market's seen this for a bit. This is part of the reason why China's stock market's been really bad. The part that's got our attention, or it's got the market's attention over the last week or so, has been these pronouncements on the property sector. And so, President Xi, the president of China, has made it a point during his reign to want to delever the property sector in China. It's a massive sector. And he made a statement, something akin to houses are for living in, not for speculation. And that really turned people in China sour on investing in real estate, which then turned the real estate market sour. And it's important for China because people invest, basically that's their investments, is their houses. This latest pronouncement, this latest set of new changes and rules have made it basically easier to buy houses. They're lowering down payment requirements. They're not forbidding people from buying second homes. They're basically turning on a dime a little bit. And so what we have to be cognizant of, and when trying to figure out China, is that last time, remember China had zero COVID policy for a long, long time, and nobody knew when they're going to come out of it. It seemed crazy and wild. Like, why are they trying to contain zero? Like, COVID is zero. They're just crushing their economy and crippling their population and blah blah blah. And then just one day he changed his mind. Just changed his mind. He's a dude, and he's a dude with autocratic power. You can't, what he wants to do is what happened in China. And so he changed his mind, and zero COVID policy ended overnight, like that, like a snap. And so this can happen. These changes in policy can happen overnight in a snap. We have to recognize that. And so that's what we're trying to do. We're trying to recognize it, and we have taken steps in portfolios to account for this development. We don't think it necessarily changes things on the medium term or the longer term for China. We still think they're a challenged economy with really large structural headwinds. But for markets and for portfolios, it's going to have a pretty material, impactful shorter term impact, and probably through the end of the year. So it's something that's sort of our take on it right now. Because we're awaiting more announcements and more data over the coming week. They've been on holiday for the last week. We'll get more here shortly. But it is a potentially important development. But we got to read it out and see what actually comes to fruition, because the market's been fooled by some of these pronouncements in the past. We don't want to get fooled again.
Good stuff. Awesome. Scott, really appreciate the time and really appreciate the thoroughness with which we were able to walk through some of those questions that we were getting. To everybody that was able to join us today, thank you so much for the time. Glad that we were able to walk through what we're seeing here at Horizon. As I mentioned at the beginning, we'd love to continue the conversation, whether that's a conversation with your strategist, a conversation with a regional director. You reach out to us, we'll be reaching out to you. We'd love to have those conversations as we head into the fourth quarter, head into the end of the year. As we've said, there's a lot of interesting dynamics that are at play. Love to help you make hopefully as good of decisions as possible for your clients when it comes to that kind of asset allocation, portfolio management piece of the pie. So without any further ado, we will wrap up today and look forward to seeing many of you here soon. Thanks so much.